In today's financial world, you're just getting bombarded with noise, right? Stock tickers, hot tips, this constant pressure that you have to do something right now. But what if there was one simple question that could just slice right through all of that chaos? A question that's inspired by some of the sharpest investment minds, period. Okay, let's get into it. This is the 20-year test.
All right, first, we've got to understand the arena we're playing in. The modern market, it's really this place of deep conflict. It's a constant tug of war between two totally opposite ideas. And honestly, figuring out which side you're on, that's what decides if you're going to build wealth or just, burn through cash.
The absolute legend, Benjamin Graham, he laid it all out perfectly. On one side, you have investment. It's all about doing your homework, making sure your money is safe, and getting a decent return. And on the other side, well, you've got speculation, which is basically everything else. And that one distinction forces you to ask a really tough question. Are you analyzing a business, or are you just betting on a price? Which game are you really playing?
Now you might be thinking, oh, speculation, that's for day traders. But the data, it tells a totally different story. The great John Bogle, the guy who founded Vanguard, he pointed out that even the pros, the people we actually trust with our money, have pretty much given up on real investing. They're not acting like owners, they're acting like gamblers, just shuffling a deck of stocks.
85%. Think about that number. That's the average annual portfolio turnover for U.S. equity funds. What that means is the typical fund manager is holding a stock for just a little over a year before they dump it. That is not long-term investing. That's high-speed speculation. And as we're about to see, it comes with a massive, massive price tag.
So, how do we break out of this crazy cycle of speculation? Well, we turn to the wisdom of the giants who gave us the cure, Benjamin Graham and John Bogle. Their ideas are absolutely timeless, and they're the bedrock for our 20-year test.
This right here, this is Graham's #1 most important principle. A stock is not just some lottery ticket. It is a tiny piece of a real business. When you buy a share, you become an owner, and that one simple idea, it changes everything. It makes you stop asking, will the price go up, and start asking, is this a fantastic business that I actually want to own for a long, long time?
Bogle, he boiled down his entire philosophy into 3 just beautiful, simple rules. Number 1, invest you must. You can't win if you're not in the game. Number 2, time is your friend. Compounding needs runway to do its thing. And number 3, and this is probably the most important, impulse is your enemy. The biggest threat to your financial success isn't a market crash. It's you reacting to it. And this is one of my all-time favorite metaphors in finance. Graham saw the market as this emotional pendulum. It's always swinging back and forth, from this crazy, unsustainable optimism where prices are just nuts, all the way over to deep, unjustified pessimism, where it feels like the world is ending. The intelligent investor, they don't get caught up in that swing. They just stand back, stay realist, and use the market's mood swings to their advantage.
Okay, so we've got the chaos of today's market on one hand, and the timeless wisdom of the giants on the other. Now, let's put it all together into one practical, powerful tool. This is how you can apply their entire philosophy to every single financial decision you make.
And here it is, the 20-year test. It's inspired by all the greats, from Graham to Buffett. Before you even think about hitting that buy button, you ask yourself this one simple question. Would I be happy to own this investment for the next 2 decades? If the answer isn't an immediate, gut-level yes, then you got to ask yourself, why are you even thinking about buying it for 20 minutes?
The real magic of this question is how it just completely resets your brain. It forces you to look past all the daily chatter and focus on the quality of the actual business. All of a sudden, its long-term value becomes way more important than its current price. It's an instant filter for speculative fads, and most importantly, it puts you in the mindset of an owner, not a gambler.
Now listen, even if you completely master the long-term mindset, there is a silent killer out there just waiting to eat up your returns. It's probably the single biggest obstacle to building wealth, and it's the one thing the financial industry really hopes you don't pay too much attention to. This was John Bogle's battle cry. Costs matter. Those tiny little percentages you see listed as fees, they might seem totally harmless. A point here, half a point there, no big deal, right? But over an entire lifetime of investing, their impact isn't small. It's absolutely devastating. So let's just look at 3 funds. You've got a low-cost index fund, maybe it charges 0.2% a year. The average fund is charging around 1.5%, and then a high-cost fund could be up at 2.2%. The difference between the cheapest and the most expensive here is just 2%. I mean, it doesn't sound like much, does it? Well, let's see what happens when you just let the clock run.
This is what Bogle called the tyranny of compounding. You take a $10,000 investment over 40 years. That little 2% difference in fees, it doesn't just chip away at your return, it consumes it. The high-cost fund might leave you with what, about $217,000? But the low-cost fund, over $450,000. That is more than double the wealth, all because of that tiny fee. See, costs don't just subtract from your returns. They compound against you, year after year after year.
And hey, don't just take it from John Bogle. This is Peter Lynch, the legendary manager of the Magellan Fund, literally one of the greatest stock pickers who ever lived. Even he admitted that because costs are so destructive and because beating the market is so hard, most people should just own a simple, low-cost index fund. The takeaway here is, keeping your costs down is just as important as picking the right thing to invest in.
So, we've gone through the chaos, the wisdom, a powerful test, and the hidden danger of costs. What does this all boil down to? What's the one ultimate lesson we can take from these investing giants?
And this is it. This is the most important takeaway. Everyone is out there looking for a secret formula, some kind of hidden knowledge. And Bogle reminds us, there is no secret. The path to success has been hiding in plain sight the whole time. Buy businesses, not ticker symbols. Think like an owner. Be patient. And keep your costs as low as you possibly can.
So, I'll just leave you with this question. Go and look at what you own. Pick anything in your portfolio and ask yourself honestly, am I willing to hold on to this for the next 20 years? Your answer is going to tell you everything you need to know about whether you're truly investing or just playing the market's game.